Now the part of our show where we discuss three things that I think individual investors should be focusing on before you make your investment decisions. And here we have our three for our show today. Investment ideas that surge or fall during wartime. As I mentioned off the top of the show, war is usually bad for the markets, but there are certain segments or sectors of the market that benefit and go higher when a war like we're seeing now in the Middle East breaks out. We'll talk about what are the ones that are going up, what sectors, and the ones obviously that we're seeing negative effects on. Economic indicators to watch. There always seems to be economic data coming out. We have some economic data coming out at the end of this week, early next week, and late next week when the Canadian jobs report comes out, I believe, next Friday, so 1 week from today. Law of large numbers. What does that mean? Well, simply put, the larger the number, the more you could see a bigger sell-off number or perhaps an increase in number. But if you take it as a percentage, it really isn't a big thing. And I'll explain what I mean shortly. So let's move to our first top three idea, which is investments that surge or fall during wartime. So there you have it, a nice little illustration there with a barrel of oil. Yes, of course, oil would be one of the sectors of the economy that will be affected if there is a war that breaks out in the Middle East. So, of course, war breaks out between US, Israel, and Iran, and the price of oil, of course, moves up. Now, I don't think, to me, the interesting thing is that oil moved higher. To me, I think is by how much it moved higher. And to me, it didn't move higher much at all. I don't think the price of oil moved that much to the upside. Perhaps if this war broke out 20 years ago, you might have seen WTI, which is the oil price in America, in the US. You may have seen that $90 to $100 a barrel. I think at the highest point in the last couple of days, it got up to maybe 77, up from about 67, where it was trading prior to the war breaking out. And today, before I came on air, it was actually negative. Price of oil was down. I think it's down somewhere around $73, $74 a barrel. Our first chart that we have shows oil prices and how they spike. There you have it. Brent crude is the oil price in Europe, and it's always a little bit higher than WTI, which is a little bit higher usually than our oil price here in Canada, Western Canadian Select. And so here you have Brent crude spiking up to almost 80. It actually passed $80 yesterday. And WTI got as high as 76, 77, and now has pulled back into the low 70s once again. So here you see a sector of the market benefiting from the war. I don't like to use the word benefiting, but price of oil going higher. So obviously, anyone who's invested in oil or oil stocks would have seen their share prices or prices in general move higher. Next chart here is just on WTI crude. And you can see on March the 2nd, you see that straight line up. That was a gap up in oil prices. That was the Monday that just passed. And you can see really oil kind of floundering and spiking higher yesterday, but has come right back down again as announcements are made regarding the war, how the war is going, what the U.S. has done to guarantee passage through the Strait of Hormuz, which is a very narrow passageway for oil tankers to get through. We know that 20% of the world's oil goes through that strait, and Iran initially said that they're going to block it, that anyone traveling through it would get blown up or set on fire. Well, the United States yesterday said, if you're going to go through, you will have a Navy escort, a United States Navy escort. They also helped with respect to insurance on these vessels, saying that they would cover that as well. So when that was heard yesterday, price of oil fell significantly. What else goes higher when a war breaks out? As you can imagine, what goes higher anytime there's more chaos in the world? The price of gold. Our next chart is a price of gold. And again, as you can see, beginning of March, kind of just off center a little bit towards the right center of your chart there, a straight line up. And again, we saw gold moving higher temporarily, comes back down, moves again higher at the start of trade yesterday, and then write back down again, because once again, situation, it's one of those things fire first and ask questions later. So right away, gold, I should say, moves higher along with oil. And then, level heads prevail and people start looking at selling off gold a little bit after they have that initial burst. And we saw gold prices get up to 5,400 an ounce. And today, as I said, sitting somewhere 51, 5,200. Next chart here shows another sector of the markets that you may not think about as much. This is the aerospace and defense sector. These are predominantly U.S. defense companies. Again, March 2nd comes. Look at that straight line up for the defense stocks. Northrop Grumman, General Dynamics, L3 Harris, RTX, and last but definitely not least, Lockheed Martin, the company that makes the F-16s and the fighter jets and helps make the Patriot missiles that defend Israel and other countries around the world. Defense companies spike higher, and then they get a bit of a reprieve. They go back down, give back some of the gains, like gold, and move higher once again. And now, showing some stability, we know that defense spending has gone up since President Trump took office because he's vowed to build up the military again, and he is forcing countries around the world to spend more on defense, up to 5% GDP on defense. And so who reaps the rewards of that? Defense companies. What sectors of the market go down? Well, many of them, but obviously just highlighting a few. Invesco QQQ, our next chart, is one for tech stocks. So on March 2nd or 3rd, we saw tech stocks fall, but have since rapidly recovered as the market has started to gain a little momentum. Perhaps the worst may be over. Perhaps the war that was rumored could take maybe as much as 4 to 5 weeks. Maybe it's going to be over a lot sooner. We heard some rumors today that Iran has been reaching out to the United States through back channels saying, what can they do to end this war? So if that is true, maybe the war ends a lot sooner than some people, even the president, had anticipated. Another sector of the market that goes down when a war breaks out, which is quite logical, which would be your airline stocks. We have the Jets ETF. No, it's not the New York Jets in football. It is the Jets ETF. I love that JETS represents the airlines, and a great ETF there. And you can see that the airlines have fallen. Why? Well, obviously they're not able to fly in certain areas of the world because of the war, and that is obviously affecting the airline stocks. Last but not least, for this part of our top three, we have the overall segments, our sectors of the economy. There you have it. I think probably the most important thing to point out is a 3-month sector performance, which is right in the middle of the energy sector, up 25.8% over the last 3 months. Over the last month, almost 11% higher. That is the big winner when it comes to this war and which sector has been going up the most. So you want to be mindful when you're making your individual investment decisions. What sectors make sense at the start of a war? Which ones may start to sell off a little bit, sell off from those highs as the war keeps moving on. And so building out a portfolio, these are the things that I believe you need to keep in mind. Our second point or investment idea that you need to be focusing on when you create your portfolios at this point in time, which is economic indicators to watch. And we can show that, yes, jobs and CPI. We're going to get jobs data out of the US. That is coming this Friday. Our first chart shows how jobs have fared in the US on a monthly basis. You can see January was a fantastic number. I think I would not be surprised to see if that is altered and maybe the number wasn't as high as first indicated. But 130,000 jobs created in January. The expectation is for about half that for the month of February. U.S. Consumer Price Index, CPI, that's going to be released early next week. And CPI was quite tame the last time it came out, showing an overall increase. We can put that chart up on U.S. Consumer Price Index. There it is, 0.2% increase, or about 2.5%. And the interesting thing is, if we show our next chart, PCE, which is the more favorable way of looking at inflation for the Federal Reserve, they're showing the PCE numbers, personal consumption and expenditures, are actually showing a higher rate of inflation, closer to 3%. So it's going to be quite interesting to see what the CPI numbers look like come next week. Will it be in and around 2.5%? And not sure why the PCE is showing much a larger number. Perhaps the PCE we know doesn't take into account as much real estate, whereas CPI has a bigger real estate component to it. And we know real estate prices have been falling in the US and even here in our country. So maybe that has brought down inflation in the US. But overall, I think we're going to be looking for what CPI numbers come out now and relate them to the PCE numbers we got not that long ago. And I will mention, even though we don't have a chart on it, but as I said, we're going to get some jobs data from Canada at the end of next week, next Friday, and that's going to be important for the Bank of Canada to think about interest rate policy, I'm sure, and obviously important to our government as well. Our third topic to look at, consider, focus on is the topic of the law of large numbers. So what do I mean about the law of large numbers? Well, the best way to explain it is by showing you a chart of the Dow Jones. We can pull that up. There you have it. The Dow Jones down 400 points at this chart where this chart was taken. At one point yesterday, the Dow Jones was down about 1,200 points. But let's consider law of large numbers. When the Dow is down 500 points on a 50,000 point index, well, that's 1%. In this case, a little less than 1%. When you look at these big numbers and when people see the Dow down 1,200, the S&P down 160, people start to panic. Emotion takes hold. Oh my goodness, down over 1,000 points. But down over 1,000 points is nowhere near what down 1,000 points was years ago when the Dow was, 20,000, 30,000 even. Today, the Dow is in and around 50,000 points. You lose 1,000 points, you're down 1%. That 1% could be made back the next day or over a couple of days. It's not a reason to panic and make a silly decision. Let's look at the S&P index next. We can see here, look at the S&P trading just under 7,000 right now. So when you see the S&P down, in this case 65 points, it's less than 1%. Back, I guess, in 2020, when the S&P was closer to 2,500 points, 65 points would be a much larger percentage. So always look at these indices in terms of percentage. The law of large numbers says, obviously, the bigger you go, the bigger movements point-wise you're going to get, but it doesn't mean you're losing more money as a percentage. And I always tell individual investors, don't think in point terms, think in percentage terms. Our next chart is the TSX. You can see here, TSX right now sitting at around 33,000, 34,000. Once again, what does a 500-point decline mean, to the TSX? Obviously, a lot less than what it have meant, many years ago, or maybe even just a few years ago, back in 2020, prior to COVID. The last thing I wanted to mention with regards to the law of large numbers, we could also see large numbers factor into earnings. Our next chart, or our last chart for this segment, is one on NVIDIA. Look at that chart on NVIDIA. Look how it's basically been trading in a range for quite some time now. You're going to have to go back maybe 8-10 months to see a surge in the stock. Again, law of large numbers. You're going to have to really impress if you're NVIDIA to see this stock move to the next level. The bigger they get, the higher their profitability, their margins, their market capitalization. Almost just under a $4 trillion company at one point, or almost a $5 trillion company. This is a company now where the bar is set so high that even when they report blowout earnings, margins in 75, 77%, basically representing 7% of the S&P 500, what's it going to take to move NVIDIA stock higher? You're going to have blowout numbers. They had blowout numbers, and the stock still didn't move higher. So difficult to say what moves the needle with NVIDIA. But once again, when the bar is set high, when your stock and your company itself has gotten so large, it becomes very difficult to move the needle. So don't forget, when you're investing, the law of large numbers. What's it going to take for the markets to move to the next level? What's it going to take for a stock like NVIDIA to go to the next level? And keep in mind, if you do see sell-offs happen or even large movements to the upside, look at the percentage growth or percentage loss. Don't look at the overall number, because in my opinion, when you look at just numbers, it becomes an emotional thing and you may make the wrong decisions based on the numbers themselves.